What I'm saying is that the economy is coming to, we are right here now where the coyote is running over the cliff, and all of a sudden you will see that there's no ground beneath us. And that is the problem when the economy comes to that halt, and the whole stock market is so overvalued as it is right now. It's completely, insanely overvalued.
Hi, and welcome to Wealthion. I'm James Conner. Well, here we are in the last few weeks of the year, and one of the things I always like to do as we head into year end is create a financial plan for the upcoming year. And if you would like to create a financial plan or have a discussion with a financial advisor and talk about some financial goals, visit wealthion.com/free to speak with a financial advisor. Once again, that's wealthion.com/free to get more information. Henrik, thank you for joining us today. How are things in Copenhagen?
They are great. Christmas time is always a great time of year, so all good here.
When we first spoke this year was early January. I can't believe it was almost a year ago. But at that time, you were very bullish on the S&P, and your target on the S&P was 6,000. And even in August, when the market got hit and lost 5% in a week, and everybody thought this was the beginning of the end, and you didn't waver. You still remained bullish, and your target at that time, I think you took it up to 6,100 to 6,300 on the S&P. And at that point, you said we would see a blow-off top. And here we are with a few weeks to go in the year. And I want to get your assessment on where you think the markets are and how do you think they're going to shape up for 2025?
Yeah, so we still have some room to the upside. So we are around 6,100 now. I think there is just a little bit upside still in the S&P. I think we are getting very close on the Dow Jones, and I would like to think that those two could actually top out together. But I think the Nasdaq may push a little further. So again, with everything here, I don't focus so much on when, but it's more about which level we are talking about. And the 6,100 to 6,300 still stands, even though I could also see a really strong push into 6,400 if that's but that would be within the the margins of errors, I would say. But that's where I stand. So we are getting closer into it. The structure into the that I look at for the S&P 500 is developing a little more upside, but we are getting very, very close. And I would just say that when you ask me about what I think markets are going, how they're going to perform when we get into the next year, well, I think the fallout will start probably begin in January. We may even see a top here in December already for the S&P and for Dow Jones. The Nasdaq, Bitcoin may also push on for a little extra, as I said, but I think the fallouts could already start to happen in January. So and then it's going to be a tough year. It's not going to be straight down, and we will have major bounces as well, but it's going to be a very, very difficult year.
And before we do a deep dive on where you think these specific markets are going, why don't we first just touch on your analysis and how you and your approach. You use a business cycle approach. Just tell us a little bit more about that.
Yeah, so my business cycle is based on three different indicators. There is the leading, the coincident, and the lagging indicators. The leading indicator, and these are all data that we can get from the conference board. You can get it from Fred. It's just data you can get online actually. So it's not something in a magic box, but it's the way you also use these things and how you understand that they are actually the sequence of things. And I think that is where a lot of people are. What inflation is that before you see the economy is developing in a certain way and so on. And this is actually the sequencing of it and the understanding of that, which is extremely important. So what I see is that we have had the leading indicators leading the economy into a slowdown. And I've been waiting for now to see that the coincident indicator, which is the real economy, which is the production level, it's the NFP numbers, non-farm payrolls, and so on, actually starting to show that weakness. And then you have the inflation, the rates, the yields, which is the lagging indicators. For now, we've seen the leading indicators been declining for 24 months or so, and which is the equivalent of what we saw into the financial crisis. And we're actually starting to see that the lagging indicators in my model is starting to show a lot of weakness there, which is a little funny because in that, in the time between there, we should actually have seen the coincident indicators, meaning the non-farm payrolls that we had on Friday, should start to deteriorate, and the labor market. And I actually think that is happening underneath the hood. And if you really look, closely, you will actually see that the non-farm payrolls that we're getting out these days are just, I don't trust them a lot. Let's just put it like that. So I think the economy is in a much worse place than most people actually understand at this point.
Yeah, and to your point about the non-farms, I mean, they might have been good for the month of November, but give it a month and we're going to see a major revision to the downside for sure. And that's been the big theme this year. But let me ask you about these leading indicators, because you said they've been in decline now for quite a few months. But at the same time, we have the S&P and the NASDAQ making new highs every other day. How do you reconcile that?
Oh, that's easy. I mean, it's easy. It's actually, the leading indicators are something that will go, way before we start to see the decline in the stock market. So that was already in by the beginning of this year. So that is not what I'm looking for. The leading indicators telling us that the economy is now in that phase. There are 4 phases in the business cycle. We'll make it take a little too far to go into details here, but they are telling us that things are deteriorating. That you have the yield inversion that we still see we have the 10-year minus the 2-year, which has uninverted again. You have the 10-year minus the 3 months, which is still inverted, which is also a signal of the recession, setting in, not in a too distant future. But the thing is really about the coincident indicators. When do we start to see that slowdown in the economy, in the production levels, and in the non-farm payrolls, the labor market that we should see? And that's why actually back to it. Even though you said it, they were good. Actually, I think they looked very suspicious, I would say. And I'm not wearing a tinfoil hat here. But if you look at the BLS, so the bureau that carries out these surveys, if you look at their own numbers, you can actually see that they have been, we have seen a decline in the full-time time jobs over the last year of 1.3 million. The part-time jobs have been going up by 500,000, so a net around 750,000 in negative over the last year. And even though, if you then look at the non-farm payrolls, they tell us that we have been creating 2.7 million jobs. Something is off. And I just have to say, at the same time, on Friday, we also saw that the unemployment rate moved up to 4.2, and we also saw that the participation rate actually fell. So there are certain things around these coincident, about the non-farm payroll that doesn't add up at this point. And I think that is actually the thing. People are looking at the numbers at face value and not understanding what is happening down beneath those.
Yes, and to your point about the unemployment numbers, it bottomed at 3.6%, I believe, and the trend has been moving up, and the last number was 4.2%. So it's going to be interesting to see where the numbers go as we approach or into 2025. So you also touched on interest rates in the 10-year, and that bottomed around 360 here in the last few months, and then we saw that move higher. And now I think it's around 420, but it got up to like 440, 450. What do you think that's telling us?
Well, I think it's like everything else. When you look at markets, nothing moves in a straight line. And as I said, the deterioration in the lacking the indicators that I have is actually part of that's the yield also included in that. And you will see that, when you have a decline, and you've seen it, the yields declining since early this year, then of course there will be bounces on that way. So what I think we are actually at this point here, we are at a very important inflection point where we have seen this small bounce now, and I'm starting to see that we can see that the yields are now starting to turn downwards again. And I actually think we're going to see a decline from here, which then means that the next phase is setting in. And I compare that next phase we see here with what we saw also in October of 2007, where we actually saw that the yields were starting to decline again rather strongly, because things were not great. Back then, nobody understood that we were so close to a recession. We were 2 months away from the recession, but yields were telling us that. And I think we're going to see that for the next coming weeks and months here. You'll see yields coming down strongly, and that will be telling us that things are, the economy is starting to deteriorate even worse, even more than we, have seen over the last few months. And that is going to, we'll see that when we get into the early parts of 25.
So a big part of your thesis is deflation, and this is going to impact many asset classes, including the equity markets and Bitcoin, gold, oil, etc. Why don't you take us through this thesis and why you think deflation is going to set in?
Well, first of all, when we look at what the Fed is doing right now, we expect them to cut by 25 basis points at this point, at a time where inflation is not a problem. I mean, the latest few numbers that we have had, and I think we had this week as well, have been very, low. And if you compare it to just 1 month before we entered recession in 2001 and 2007, inflation numbers were way higher than that. So the Fed now is scared of what they unleashed, or what they think they unleashed when they came out with the cuts. They thought that they could keep inflation rates at 2.5%. That was what they said. And what happened was that they went to 9.1. So now they got scared and say, oh, we miscalculated this. But what they're doing now is that they're actually, doing the opposite. So now they're being way too hawkish at a time where you can see that the economy is coming into a halt. And again, this is where, if you do not look under the hood with the numbers on the coincident indicators, and you look at it like what the Fed is doing, then you will be way late to the party, which the Fed has been all the time. So the deflationary part here is because the slowdown in the economy and the halt that we're going to see the economy come to. I mean, we have to remind ourselves, we only had a 12,000 job numbers in October, and then people said, yeah, it was because of the hurricane and so on. Well, people just have to explain me why. We have seen the unemployment rate just keep going up, first of all, and we have 4.2%. And we saw 161,000 new people actually becoming unemployed, extra new people unemployed in November. So what I'm saying is that the economy is coming to, we are right here now where the coyote is running over the cliff, and all of a sudden you will see that there's no ground beneath us. And that is the problem. When the economy comes to that halt, and the whole stock market is so overvalued as it is right now. It's completely, insanely overvalued. You have, the euphoria that I talked about a year ago also is now slowly starting to develop. We have Bitcoin at about 100,000, and people think it can go to 1 million and so on. I mean, these things are the very definition of that bubble that we're in right now, and especially also if you look at the valuation levels for the stock market. So at some point, that will all come to, actually when the economy catches up with the stock market, or the reality comes to the stock market, we'll see, okay, then things will start to decline. And I can just see that with these kinds of valuation levels, there will be a large gap, down. So we're going to see a large decline in the stock markets. And that will also set its trade. You'll see that in the economy as well. I mean, right now, the U.S. consumer and consumers around the world are not doing well. You see that in the delinquency rates that I spoke about, previously also, and you see that we actually do not have an economy that is rather strong here. You see, it's part-time jobs. People are taking up 1, 2, 3 jobs, or 2 extra jobs sometimes to actually just cope. That is not the very definition of a strong economy. So this, and with the extreme valuation levels, we have it also, just look at in PE levels in, historical basis, we are at extremes here. And when that, that's an inflated balloon here. So when that comes, when the air comes out of that, that is a deflationary force. That is not stagflation. That is deflation. That is price pressures on a lot of things. Capacities have been built up over the last few years where that is not being utilized at this moment. Commercial real estate is, in a complete, state of denial at this point also. So you will see that these things here will actually come crushing down, and that will have in price pressure. And that is deflation. That is not stagflation. So as people start to say. So when that starts to happen, we will see the Fed coming out again, blazing and, trying to stop this. But first we'll have to see that top. And right now, everybody seems to expect that this can just go on. And I'll be wrong.
So in 2021, the Fed made a major policy error when they said inflation was transitory. And then by Q1 of 2022, they realized they had a really real problem on their hands when inflation ripped to 9%. But you're suggesting now the Fed is still way behind the curve, and they're making another policy error by cutting interest rates too fast and too aggressively?
They're not cutting them enough right now. The problem is that they're not cutting it. Right now, when you're setting things in motion, and especially something like the economy, which is a super tanker, then there is a certain momentum behind it. And when that gets going, in the first you'll see that if you push in in certain direction, you'll see it start moving. But they keep pushing on it right now. And the economy is not in a state where the Fed fund rate should be at these levels that we have right now. Absolutely not. And that you see by, interest payments on people is just killing the consumer. So what they're doing right now is that they are, again, way behind the curve. They look at inflation rates, which are lacking lagging indicator on the economy. And that means that they will be, horribly wrong just on the other side now. So their policy mistake this time will be to the other side. So as bad as they went to the deflation side, they will do probably now on the deflationary side. So this thing is going to come crumpling down. And and they will come out again, and like a drunk driver, overreacting in one direction and then reacting in the other direction. And that's what we see. This is the drunk driving of the Fed, and I think it's terrible to look at because they're simply using the wrong indicators.
And one of the big unknowns about 2025 is that we have a new administration coming in, and there's going to be a lot of changes, a lot of policy changes, deregulation, taxes, reduction in taxes, an increase in tariffs, and also changes to immigration. And we really don't know the impact, what all of these changes are going to do to the economy. But to me, a lot of them will be inflationary. Like if you cut taxes, that's going to be inflationary. People are going to spend more. If you impose tariffs, that's going to result in higher inflation. Are you not concerned we might see a pickup in inflation in 2025?
Yeah, sure. Absolutely. But again, I think that's what I talked about also on previous shows. I think there's going to be a whipsaw. So I think that what we're going to see is that the deflationary forces that are in play right now are in control. And that we can see because people are not spending, that as they should, and we see the consumption simply not being there where it's supposed to. So we don't see a pickup in that, so inflation can become a problem. In order for inflation to become a problem, we need to see exactly that. We need to see excess spending. We need to see that the money starts to circulating faster and faster. We don't see that, and that's why I say that the deflationary forces of the economy right now is in control. And I think the Fed is scared of some of these things here and what it unleashed. And that's why if you look at the momentum charts for inflation and for yields also, then the momentum is to the downside at this point. What you're then talking about is things that will come through and will be happening at some point in 25, but that's not creating inflation at this point. That will create the opposite again. And that you can have the perfect cocktail there, because then you may also have the Fed coming out blazing because they say, oh, now we stare at inflation again in the face. They will have to do something, and then you have all the things that can come out there from the administration as well. So, yeah, I do fear inflation, but not at this point. And again, it's not just about one direction or the other. Actually, these things can turn pretty quickly, and especially if you have a downward force and you got all these things setting in motion, then the upward force on inflation can be setting in during 25, late 25, I would think, and then into 26. And that would be the next problem, especially if the economy is still sluggish, and I think it will be, because then you'll have the worst thing you can have, a sluggish economy while inflation is picking up, which is stagflation. And that will be bad for a lot of people.
I want to spend some time on stagflation, but before we do that, I want to ask you about this whole element of euphoria that you touched on. And I think one of the things that really shocks me about this market, or maybe in the last 5 years, is it's just not one bubble, but it's mini bubbles, right? It's what John Maynard Keynes called animal spirits, and that's what's feeding everything. Oh. And I guess it has to do with cheap money also, but cryptocurrencies, right? There's over 9,000 different types of cryptocurrencies now. NFTs, yeah. You may recall, I think it was in 2021, somebody paid $69 million for an NFT by an artist by the name of Beeple. And then we had the metaverse. And that was another bubble. Now nobody talks about NFTs or the metaverse. And now I guess the big bubble is anything and everything to do with AI. And the poster child for AI is NVIDIA. And it's up 180% on the year. But maybe you can just speak to these bubbles. And I know you're a real student of the market, but how does this time we're living through right now compare to other bubbles? And why do you think it just keeps going from one asset class to another?
So I don't think we're talking about many bubbles here. I think we're talking about one big bubble that is just, keep developing. And we haven't really seen the popping of that. We've seen a decline in the markets, but it was saved again, also even in Corona, and all the things we have seen over the last few years is just, adding up to the big one that we have right now. So I think I talk about what we have right now as the everything bubble. We have a bubble which includes, crypto and AI and everything we have, because everything has been, just been thrown money at it. And that's what we see developing. So I don't think these are, small new things that are coming. It's just part of the whole thing. And that comes back to the whole, what is the driver of this? First of all, it's the easy money, environment we have had for so many years, and it's been changing over the last few years here. And I think that is what's going to do a big change down the road. But until you can say that the inflation started to move up, we saw that money was just thrown at everything. And we had these new technologies coming out. We had AI, we had blockchain, we have all these things, which are wonderful technologies, and they will change the world 100%. They were going to change the world, just like what we've seen so many times before when the the railway came out, and we had the technology of the steam engine in the 1850s. You had the automobile and so on in the early 1900s, and all these things are technologies that comes up. And what happens every time around that? You can also go back and 180, 170 years to look at around the railways, at the railroad and the steam engine. You have bubbles emerging from that. You have, companies popping up and say, oh, now this is going to be something fantastic. And everybody's trying to figure out how it all fits in. And that's what happens this time again. So you're talking about those, thousands of cryptos there. I can tell you that I think 99% of those and 99.9% of those are going to be worthless within a couple of years. And I'm even in some of these right now. So it's the technology down beneath. It's the blockchain technology. It's the AI, but it's not the whole speculation around this right now. And that is where market is sometimes front running things and try, oh my God, this is fantastic. And they're just throwing the money into it, which builds up the bubble that then bursts. We'll see some, big declines in the market, and we'll see also a lot of failures in some of these, exaggerated, in terms of valuation of companies. And then we'll see that the real ones will then emerge from this, the whole decline. So you will see that there will be another, whatever it's going to be, Amazon or whatever we saw after the 2000 also bubble there. So we will see that. But it's not going to be the thousands or the hundreds of them that everybody seems to believe now. It's going to be the normal cycle as I see it. We're going to have the bust, and we're going to see a lot of these fail. And then we'll see a few of them emerge, and there will be a real business case on those. And that will be due to the technology that is behind it. It's the technology that will drive. But it is not that will save the world at this point. We will have the bust, and then the fourth, industrial revolution is going to be set in motion by some of these technologies, I'm quite certain of.
I touched on NFTs, but I don't know if you saw that recently. There was a cryptocurrency investor. His name's Justin Sun. He paid $6 million for a piece of art, which was essentially a banana duct taped to the wall. Did you see that?
Yeah, I rest my case. I mean, this is the craziness. This is the stupidity that we see in every cycle. And every time we're told that this time is different, and no, and you don't understand, Henrik. And I know this is the thing. So yes, I did see that. And again, it's just like another tick in the box saying, okay, we got this kind of stupidity. Obviously, we're getting closer to it. So yeah.
But what was even better is that he called a press release, I guess, just to probably did it for publicity. And then he actually ate the banana.
Yeah, I saw that. Yeah, I saw that as well. Yeah.
All right, so let's talk about Bitcoin now. And once again, when you've been bullish on Bitcoin all year, you said your target was $115,000, 115, and even in August,
up to 123, I said also, yeah.
Okay, and I was going to say, even in August, when we had that pullback in the markets, Bitcoin, I think it was around $55,000. Once again, you were still bullish; you didn't waver. So just take us through this synopsis or your thesis on Bitcoin, where you think it's going. You said, where's it going now?
115 to 123,000. That's around that area. I think we're going to top out. And I think actually we're starting to see some of that weakness in Bitcoin right now. But I know that's not what people think, but we are actually starting to see some of that now. And so my thesis on it is really, go on. Sorry.
I was just going to say, we got up to 100,000 or just over, but you think it's still going to make one final push up?
Oh yeah. So again, I work with technical structures, and I was actually also expecting something of a consolidation around this level that we're at, just where we saw this past, I think it was around 95,000, 98,000, and but now we should see it pushing up into the final, and it'll be a more volatile ride from here. So we're not going to see a straight line. It's not going to be like what we have seen for the last couple of months here. It's going to be a more volatile ride, but this trend will be up, and it will last, let's say, for next month here, maybe a month and a half, and that'll be it. And then I think we're at the very end of it.
Henrik, we can't discuss Bitcoin without talking about Michael Saylor and MicroStrategy. MicroStrategy was up 500% on the year. I wish I was long, but I'm not. And now it's up, I think, just over 400%. It's pulled back quite a bit, and because he's raising money. And I don't know if you heard, but Michael Saylor is implemented this 21-21 plan. He wants to raise $21 billion in cash, $21 billion in debt, and he's going to put the proceeds into Bitcoin. And I'm not even sure how much he spent thus far, but do you see this as another sign?
Oh yeah, absolutely. And him, appearing on TV and talking about on media, talking about how we should, U.S. should sell all its gold and buy Bitcoin. I mean, complete craziness. I mean, stupidity, honestly. So just to be frank here, obviously this is again one of I actually had these very high targets on MicroStrategy. I could see it also, and I actually think I haven't studied it just for the last couple of weeks here, so I could see there could be another high on it, because I think they're going to follow Bitcoin. So I think with this, Bitcoin has not found its top yet, and I think there is a significant upside still on Bitcoin. Well, so I think MicroStrategy can move even higher here, but it's again, I have to say, and we can be on here again in a year's time. I think when we sit here again next year, new Christmas tree, MicroStrategy will have crashed, tremendously, and just like straight down to a certain point also. So it's what he's doing here is a very dangerous game, and just about betting all your whole existence on a crypto, on Bitcoin, and just saying it's just going to go up all the time. It's yielding zero, and if we get a deflationary bust that I'm talking about, and we get a stagflation as well, Bitcoin is not going to do very well. So I think it's a very dangerous game that he's playing, and it will work sometimes, and then we know he'll be a villain for a certain amount of years. But I just think this time around, if we get the lows that I can see in Bitcoin coming in after this top here, then it's not going to bode well for MicroStrategy. But hey, he's up a lot of percentages at this point. But we have seen this before. We see how things go straight up, and then in the Eiffel Tower, it normally comes straight down again. I think that's going to be the case here as well.
So it's interesting to see Michael Saylor going all like risk on in a big way, and he's going all in on Bitcoin. And then Warren Buffett, he's at the other end of the spectrum, and he's raising cash. He's sitting on a record level of cash right now, $325 billion.
Yeah. I think if I have to choose between the two, I know who I'll put my money on that. And I think it's, it's again, in a crazy world, the crazy person will seem normal. But the problem is we are in a crazy world right now. So the crazy people are the ones that will seem normal because they do the crazy stuff. Fact is, in the real world, and then we will get back to it when we see the bust also, the way of running a business like what Warren Buffett does, and obviously he's been proving, who am I to actually even just talk about that? He is, he as I see it, this is the way to do things. And at this point here, when you have crazy valuations, you want to raise cash, you want to make sure that you are ready for the next decline, you get ready for that, your credit lines and so on. And then let the crazy people talk about buying Bitcoins and selling gold and doing and buying bananas from his duct tape to the walls. I mean, these are the kind of things we see in the crazy worlds. And again, I said the crazy people will seem normal for a certain amount of time until the point where the shit hits the fan. But that's not a popular thing to talk about. So when I talk about this with people, they'll say, Henry, it's because you don't understand it. You don't understand AI. You don't understand crypto. So that's why this time you'll be different. This time is different. And let's see.
So let's talk about gold now. And you've made some good calls on the S&P, the NASDAQ, and Bitcoin, but you've been negative on gold in the short term. And it's up 30% on the year. Take us through your thesis on gold, why you've been negative.
So you can say, being early or too early is also being wrong. So I'll have to, own that. But I think what I was expecting at that point is actually what we have seen silver been doing, and platinum been doing, and miners been doing, the gold miners. They have not to a new all-time. They have not gone to all new all-time highs. And that was what I saw. That was what was in my thinking here, because the thing is that in a deflationary environment, which I think we can be heading into, you do not want to own gold, because that will be the moment where all the things are starting to come crashing down, and there will be, margin calls, there will be, businesses going bankrupt and so on and so forth. And there will be a lot of debt that needs to be paid. And that debt is in dollars. And that means that the dollar is going to go a lot higher. And I'm not talking again, and I just want to be very certain that it's not from right here, because I think that the Dixie, the dollar is going to decline somewhat here down to 97, 98 on the Dixie. But after that, I think we can see 122 into, later of 25. on the Dixie, which will be a massive rise in the dollar towards all currencies around the world. And that will happen in a deflationary environment. You do not want to own precious metals in that environment. And that's what I'm saying, that I think you can see gold, actually, I said, after been wrong on that, saying, okay, I can see now we can see maybe 2,800 or something like that. But, and we are up around that level. I can see maybe a new high, but I think gold is going to come down. And I think it's going to come down by 40, 50% as a minimum into this deflationary bust. We've seen it before. Every time we get a recession, you'll see those kind of crashes in the market, on the gold market. And you saw it also in silver. And again, you need silver, platinum, gold miners, and gold to move up together. And actually, you need silver to be the one that is taking the lead, because if you don't, then it's not really a gold bull market. So I will actually argue, even people say, but it's up 30%. This is not the real thing. What we're seeing here is actually a correction in that move, and that's why, in my model world, I would be right, but it's hard to explain that to people. So yeah, I have to own that it seems like I was wrong on that. But let's see if we don't get a big correction into a deflationary bust that I think could happen, starting soon, actually very soon.
And what's your ultimate target on gold?
To the upside or downside?
For the downside.
To the downside, I think we can hit around 1,350 or something like that, 1,370 or something like that to the downside. It'll be a rather big decline. And that's what you see. That's what you see into these busts where cash is everything, where dollar is moving up strongly. And if the Dixie really goes to 122, then you'll see gold suffer a lot. So let's see about that. And again, when the top comes, people will not be in doubt. There will be a lot of declines there. And that normally happens into that very illiquid phase of the deflation. You saw that in March of 2008 until October 2008. Because there was simply nothing, you're starting to see the bad things unfolding. You had the Bear Stearns in March of 2008, and that's where liquidity becomes scarce. There, you do not want to be long gold. So that's what I see, and people don't like me for it. It's fine. I still have to call what I see in the models. But when we turn from that back at that point, when the Fed comes in, blazing, liquidity, pumping liquidity into the market, I'm quite certain we're going to see gold, embark on that real bull market that everybody has been expecting. And that real bull market will take us much further, much higher.
Yes, one of the things I'm always confounded with when it comes to gold is central banks have been major buyers here in the last few years. I believe they're buying 25% of global production, which is a huge move. So I'm kind of wondering if that's what's driving the price of gold up, and that's not really the real price. It's like an artificial price. And that's why a lot of the equities are not participating. There's a few gold names, or a few gold producers that are, but there's a lot of them. Newmont comes to mind. It's flat on the year, the world's largest gold producer. Barrick, second largest gold producer. It's down on the year. So maybe Newmont and Barrick are representing the real gold price, which is significantly lower than where it is right now.
And that's actually been my point. And the same goes with silver. So what I think we've seen actually, that it's not a bubble in gold. It's not that I'm saying gold is in a bubble. I'm just saying it's bubbling. I mean, it's like people are expecting inflation to come, and you need to buy gold when there's inflation, and central banks are getting ready for this big reset or whatever. They also can see, because they can also understand that you cannot go on with this crazy monetary policy. So they start to buy that also. And that's why you can see the gold bubbling. But it does not mean that gold will have to take the big move up. And you will actually start to see that it can be sold off in a situation where people needs liquidity. And that means that maybe it's not the physical price of gold. So if you go buy physical gold, it may not be able to buy that, but there'll be the futures price that we can see on the exchanges will, likely drop a lot. So I think what we're seeing here is a kind of a front running or a bubbling of gold here, and that's been driving it up to the highs we have seen, but it's not really the big gold bull market. The real gold bull market comes the next time, and it'll probably be sent off by a stagflationary development in the economy as the Fed comes back in and think they can just, restart the economy by just pushing a lot of money or printing money and starting it by monetary policies again. And I think they'll be very mistaken on that. So in that situation, I think gold can do fantastically well together with silver and miners. And at that point, I think also the miners and silver will, outperform gold. So I think actually that the fact that gold has been outperforming these is not a good sign for those who want to be gold bulls.
Yeah, you mentioned the strength of the U.S. dollar, and it's killing me. The FX right now is killing me. My Canadian dollar does not go very far in the U.S. or Europe or anywhere for that matter. But it's like at $1.40 right now. And if I'm using my credit card, it's probably $1.45. So that means I'm paying a 40% or 45% premium on whatever I buy in the US.
Mhm. Yeah, but I think it's going to get much worse here. I mean, I think that the dollar will again, start to rally a lot. And I think what we have seen here is simply caused by the rotation of investors from around the world stepping out of markets like the Nikkei, the Nifty, and even also in Europe, and thinking the US is the strong place. That's where you need to have your money. So they've been pushing the money into that. And I think that's what we see. That's why we're seeing this move up. Doesn't mean that everything, again, as I said, nothing moves in a straight line, and also the DAX is not going to move in a straight line. And I think we'll have another low on that before we start to see the real rally. But the real rally is going to be very, very strong, and I think it will not last for long. But it will be the thing that actually causes the Fed to come in, because as the most debt in the world is actually denominated in US dollars, this is something that is hurting the world economy, and I think that's what we can see into the early part of 25.
So let's summarize a lot of the points you just made, okay? So first of all, going into year end in early 2025, you're looking for what you call a blow off top. You expect the S&P to go to 6,100 to 6,300? Do I have those numbers right?
Yeah, and as I said, I think when we wrote back and forth on the email there, I think that, it doesn't even need to be into January. I mean, the S&P here could reach these levels here also in December, and even in I think there's going to be a Santa Claus rally, but be careful after that. That's my take on that.
And then with Bitcoin, once again, you're looking for another blow off top. It's currently around 100,000. You still see that going up to 115 to 120,000?
123,000, around that. Yeah, there are two FIP levels that I'm working with it. So it can be anywhere there in between, depending on. So 115, 123,000, maybe topping out a little later than the S&P, but approximately at the same time with the NASDAQ, as I see it.
And then as we head into 2025, you're expecting the U.S. economy to slow down, and it's going to happen rather rapidly. You think the response from the Fed is going to be too little, too late, and we're going to head into a period of which you're calling stagflation, which is a slowdown in the economy, but at the same time, inflationary prices.
Yeah, so first, the deflationary phase, and I think it's important to say it because a lot of people think, why don't we just get stagflation immediately? But I think the bust that we're going to see and the ferocity of that, the speed of that is what is going to bring the Fed in again. Because right now, the Fed is fearful. I mean, they are fearful of cutting interest rates. And I think, when they start to see what can unfold in 2025, it will be much more than just cuts in the interest rate. What will be needed is much more than that. And when they come in, full force again. What I mean there is like what they did in the Corona or also in 2008 in October. That's what I'm talking about. That's the kind of big move, and that is where the whole game changer is going to set in. And we see gold bottoming out, and we can see all of these things happening. So the stagflationary period is not right here. It's not the first thing we're going to see. We're going to see inflation coming down, yields coming down strongly. And then when we see the unfolding of that deflationary phase and the Fed's reaction to it, I think that's what's going to offset the stagflationary period.
And Henrik, if there was one risk to your analysis or your thesis, what would it be? So let's just assume we're talking again in June of 2025, and the S&P is, I'm going to say 6,500. What would be that one risk? One thing that you're missing?
Well, it's always interesting to hear that, of course, we can see these things happening. These are the markets. But again, I lack to see we need to see that the real economy is then starting to work. I mean, again, I saw the NFP numbers on Friday, excuse me. But when I look at the unemployment rate, and when I look at the people becoming unemployed, it's moving up. When I look at the continuing claims, it's moving up. When I look at the rest of the world, when I look at China, when I look at Germany, when I look at France, where they have problems so bad that the governments are now problems. They have elections also coming up because of some of the things that they've had in terms of problems. Well, you will see it's difficult for me to sit and say, oh, so the stock market in the U.S. will just continue to 6,500. If it is, then there's quite a lot I don't get, and then it's because the real economy is not. We will see that the bubble then can go on to 60, but then we're not going to see 6,500. If we talk in June and we haven't seen the decline, then we talk 7,500. I mean, then we are way above this, and the crazy world can just continue for some time. But I simply do not see that. There's too many things that are starting to break. The technical structure of the S&P tells me we are very close to a top, and the same goes for the Dow Jones. So I just don't see that. I think we are in the crazy world right now.
You are so right, Henrik. It is a crazy world that we're living through right now. And I want to thank you very much for spending time with us today. That was a great discussion. If somebody would like to learn more about you and your services or follow you online, where can they go?
So the best thing to do is to go to Twitter or to X, it's called these days, obviously, and follow me on at Henrik Zeberg. And there will be some links to work I do elsewhere. I work with Swissblock, and I'm the head macro economist there, and there'll be links to also some of the services that I perform together with them.
Henrik, once again, thank you and happy holidays.
Thank you, and happy holidays to you also.
Well, I hope you enjoyed that discussion with Henrik Zeberg. He's expecting a very volatile 2025. And if you would like to have a conversation with a vetted financial advisor to discuss how to best navigate these markets, visit wealthion.com/free. Once again, that's wealthion.com/free to find out more information. If you have any suggestions on who else you would like to see on our channel, let us know in the show notes below. Once again, I want to thank you for spending time with us today, and I look forward to seeing you again soon.